I don't think there is one. I think there's a case for raising rates. If you look at the ISM reports that we had on Monday for manufacturing and yesterday for services, and you put them together, you have a clear, very strong uptrend. You have an economy growing above potential. The administration itself says the economy is doing well. And inflation is above the Fed's target. And we still have the tariff feed through to fully work through, and the oil price shock of an unknown magnitude. I think there is no economic case, none whatsoever, for cutting rates.
Your definitive take is it your service to the Bank of England, your England, your United Kingdom, and also your service to the Federal Reserve. Are the bankers listening to the PhDs, the analysts that, the kids that you used to be?
Well, I think we all know that there's a voice just outside the room that's louder than all those voices. And that makes monetary policy difficult to carry out. In fact, makes fundamental economics difficult to carry out in policy circles, I think. But there are very good people at the Fed. There are very good researchers at the Fed. I think Raphael Bostic, for example, will be greatly missed because he listened to his researchers and then made his policy decisions and thoughts based on what his researchers were telling him. That's why he was the first person to call out transitory. He came up with a swear jar in 2022. So I think there are those people there. The Cleveland Fed has an excellent inflation center. And I think that, though that information is getting worked through. But I think under this Powell Fed, we don't know how long this Powell Fed's going to last. It depends how long it takes Kevin to get through hearings. I don't think there's much chance for a rate cut unless something really significantly changes. And the one wild card that can do that would be a mini 1970s rerun with a sharp move higher in oil. Not the kind of move we've had. This is contained. But if we use fundamental economics, I know you love that, Tom. We go back to Alfred Marshall, who invented the concept of the price elasticity of demand. The price elasticity of demand for oil is very low. Estimates are about minus 0.1, which means...
Okay, Paul wants to jump in here, but this is incredible. We're not reliving the 1970s oil shock.
No, we're not. I mean, what that elasticity means is if you had a 1% reduction in global oil supplies on a semi-permanent basis for the near term, you'd expect to see about a 10% increase in prices. So if we really have a disruption, and you mentioned the strength of the Strait of Hormuz, 20% of the world's oil goes through there. So if you have a serious interruption there, then you're looking at a potentially very big move in the price of oil. I'm not forecasting it. I just think we need economics to frame the magnitude of what we're seeing and history to frame the magnitude of what we're seeing. And what we're seeing is very contained right now.
There's been some reporting that just in the last week, the price of gasoline at the pump is up a little over 20 cents per barrel. When does that start becoming an inflation risk for this economy, or does it become a risk to the consumer out there who probably doesn't need another bout of inflation to deal with?
Well, there's a number of elements. First, let me say, one of the reasons this isn't the 1970s because the U.S. is now self-sufficient in oil.
Yep.
So in the 1970s, the oil price shock transferred income from the U.S. to OPEC countries. Now it reshuffles income within the U.S., but it does shuffle income away from the consumer and to producers and owners of oil companies. And I think we have to see a bigger move. But what it does do for the consumer, I believe for a long time, and research has begun to support that view, that it's the frequent purchases that consumers make that impact their expectations. It is going to the shops. During the pandemic, things like toilet paper and so on that went up in price that they didn't understand why, and that influenced their expectations. So groceries, gasoline, that has a big impact. 20 cents, 30 cents a gallon isn't a game changer for the consumer, but and the favorite letter people want to talk about in the economy, the K shape, that it will hurt those at the bottom of the K.
Economic growth, as you mentioned, continues to be solid. I mean, kind of across the board here, we had some good ISM data points here. What is the risk to this U.S. economy, to the GDP call out there, do you think?
Well, I think it's, one, a potential and just say a potential, not forecasting, for a real big oil price shock. That would definitely have an impact in terms of the costs of non-oil companies, who are the non-oil producing companies, who are the primary employers in the economy. Oil companies are much smaller, more contained in size. So I think that's one. And I just think the general uncertainty, and we've had, if you think of what this economy has absorbed, increases in interest rates, all the way up to 5.25% to 5.5% from effectively zero. The U.S. didn't go into recession. That surprised me. I was wrong on that call. The tariff shock, which I thought would have pushed the economy potentially over the edge, that has been absorbed. And the thing that has done that is productivity growth. Now, we get productivity numbers at 8:30 this morning. That is we are fortunate in the U.S. in having the potential for this big secular and long-running story on productivity. But again, it's disruptive. And people, when they look at history, look at the statistics and don't look at the people who are disrupted. And my hat's off to Governor Barr, who gave a terrific speech a couple of weeks ago on AI and what monetary policy can do and can't do.